Symbotic is an innovative robotics technology company that helps companies like Walmart, which is one of its largest customers and strategic investors, automate its logistics services, its warehouses with automation so that it can improve efficiency and lower costs. So, what's a fair price to pay for Symbotic stock is the question I'm going to answer in this video. I'm going to do a discounted cash flow valuation analysis on this robotics company and let you know what I think is a fair price and answer if I think the share price at current prices is undervalued. Let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so three of the inputs I'm going to need for my valuation model are the company's market cap, cash, and long-term debt. The company's market cap stands at $2.9 billion. The cash balance is at $727 million, and the company has zero long-term debt. I also need its average diluted shares outstanding, which stands at 104 million. You can see the company has been diluting shareholders by adding new shares to the market, raising capital for the company. Now, given that its balance sheet is in excellent shape, I don't suspect the company will need to dilute shareholders anymore, but they might if they face attractive options. If the share price jumps higher, they might take the opportunity to raise more capital, but they don't need to based on their balance sheet and their free cash flow expectations over the next several years, which I'm going to share with you next. So I do need those Wall Street analyst estimates for what the company's free cash flow will look like over the next 5 or so years. And according to the Wall Street analysts that are following Symbotic stock, they think the company's free cash flow is going to turn around from negative 102 million in 2024 up to 210 million in 2025, increase further to 410 million in 2026, before pulling back to 339 million in 2027, then going higher to 391 million in 2028, and finally increasing again to 449 million in 2029. So hundreds of millions of positive free cash flow expected for this company over the next 5 or 6 years. No more negative free cash flow years expected. And so given those prospects, that's why I highlighted I don't think the company needs to dilute shareholders. The business itself is going to generate significant free cash flow they can use to reinvest in growth if they need capital for growth. I also need the company's beta. And according to Yahoo Finance, the company's beta stands at 1.81. Now, I've been getting a lot of questions about beta, why the beta that I see on Yahoo Finance is different than the beta you might see on your trading platforms like Interactive Brokers. And it could be for a number of reasons. Most probably, it's because it's a different measurement of beta. What do I mean? Well, this beta measures the 5-year monthly beta, right? So this goes back 5 years and looking at it on a monthly basis. The beta that you might be seeing on Interactive Brokers might be going back only 1 year and looking at daily fluctuations. So based on those factors, most probably is why you're seeing a different beta than what I'm seeing here on Yahoo Finance. So double check those and see if that answers that difference between the beta that Yahoo Finance shows and the beta that another service provider might show. All right, so now that we have all the inputs, I can share with you my DCF for Symbotic. Starting with 2024, negative 102 million, as I shared with you from the source, which was ticker.com, TIKR.com. And that's expected to increase at 210 million in 2025, all the way up to 449 million in 2029. From that point onward, from 2030 to 2034, I've incorporated my own forecast for its growth of free cash flow at 35% over this transition period each year, and then settling down to the longer-term growth rate starting in 2035 at 5%. So these are free cash flows expected in the future. And the numbers underneath them are the present value of those free cash flows. The difference being is that money in the future is worth less today, and the how much less is what we call the discounted cash flow. That's why it's a discounted cash flow valuation model. And we discount the cash flows using a weighted average cost of capital, which I have at 14.67% for Symbotic. Now, the biggest contributor to the weighted average cost of capital for a company like Symbotic that has zero debt is the beta, which is the measurement of risk. So if the beta is higher, the weighted average cost of capital will be higher. If the beta is lower, as you see with some healthcare and defensive companies, the weighted average cost of capital will be lower. And that makes sense intuitively if you think about it. Beta is a measurement of risk. And if a business is riskier, investors want more of an upside to take that risk. If the business is less risky, investors are willing to take a lower rate of return because they're taking lower risk. All else being equal, investors should prefer less risk to more risk. If you're taking more risk, you want to be compensated for that extra risk that you're taking. That's why I incorporate the weighted average cost of capital to my valuation calculations, because I always like to look at risk versus reward when I'm evaluating investments. So when I discount all of their future cash flows expected, I get a value of operations for Symbotic at $8.75 billion. Now, that brings me to this point here where I need to add to the value of operations its cash balance, subtract the debt, which is zero, and you get a value of equity of $9.5 billion, and divide that by the number of shares outstanding of 104 million, we arrive at the intrinsic value per share of $91.17. That's compared to the current market price of $27.47, which suggests that Symbotic stock is undervalued. Of course, the company has experienced turmoil lately. If you recall, it had to restate its financial statements because of inaccuracies and decrease the free cash flow, the profit, the revenue numbers that it's expecting. And so that caused the stock price to crash by more than 20% when they made that announcement. That's contributing to this undervaluation as well. But according to my DCF, it suggests that this is an undervalued robotics stock.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.